What's up, everybody? Welcome to the show. You know, they say there's two things in life that are certain. One is death, the other is taxes, but that depends on how much you got to pay in taxes. So that's what we're going to be talking about today, how to pay less in taxes. If you're watching on the live stream here, go ahead and say hello. Let us know where you're from. Let us know if you're using some tax strategies. Share them below if you can. Show sponsor, none other than Virtue Health Alliance. Check us out, virtuealliance.com. This upcoming Tuesday, we're going to have a great webinar on Virtue Health and the Alliance, talking about why traditional stop loss fails small to mid-sized employers, why you shouldn't be buying it. You're going to set yourself up for failure and maybe get yourself fired. We don't want to see that. With that being said, let me bring in my accountant, tax strategist. I like to call him my tax strategist, not an accountant. James Rainwater. Welcome to the show, buddy.
Thanks, John. Great to be here, and thanks for having me.
All right. Well, look.
How do you look so happy? It's not even April 15th yet. You should be miserable.
Yeah, you must be stressed out. Yeah, you're a little busy. We just did our quarterly talk, or I should say our preliminary talks before filing. And we'll start with this is I'm putting together my crypto, filings, which who knows how that trading is going to look like. I'm almost done working on one more of the 10 exchanges. But funny enough, marketing, I don't know if I told you this, James. I mean, I knew I was going to hire James. I just had 15 other fires. So when you guys think about why is a prospect not answering me? Well, he's busy. He has other things that are more important at the time. But James kept sending me emails, and the email that got me was I sold my real estate, my office in New Jersey for $100,000 gain. And then I see an email come in from James, if you remember the one you sent out, was regarding crypto tax harvesting. So basically with that, I don't want to steal the thunder, but the reality is I basically wiped out a $30,000 tax gain, a $30,000 that I would have paid in taxes by using this one strategy. So I said, I better hire him now. He just paid for himself multiple times over. So
that's
James,
what we try to do.
Yeah. Talk to us about that strategy. I want to talk about strategies. We can get into some higher level, some deeper stuff today. Talk to me real quick about that tax harvesting strategy.
Yeah, that's a really interesting one because there's been talk in Congress about making that strategy go away. Basically, and I heard you kind of talk about it briefly on the last show, where in a securities transaction, if I own Apple, and I buy Apple at whatever is $100 a share right now, it goes down, let's say, to 80. And then, if I sell that at a loss from the 100 to 80 for Apple, I can't rebuy that stock for 30 days because it's called a wash sale. There's rules against wash sales in the securities industry, so that you can't, buy a stock, it goes down, you take the loss, buy it right back at the same position, but now you've got a capital loss you can offset capital gains with. What's interesting with crypto right now is that the Treasury and SEC has agreed that crypto is an asset. It's like having a car almost, where it's not a security. It's not considered a security. So securities laws don't apply to crypto right now. So in that case, we've had really volatile crypto markets over the past year, especially. So if you are unfortunate enough to buy in at 60 or 65, and now I think it's like, 45 or 47 right now, you've got an unrealized loss unless you sell it. And if you sell it, you can take that loss. You have a capital loss now, like you did, John, and you can take that capital loss against other capital gains. So in the event you have like a sale of a condo or other assets, even securities that you sold and have capital gains, you can use that capital loss from the crypto to offset that. But because it's not a security, wash sale rules don't apply, and you can buy right back in at the position you were in before, and no harm, no foul for that. So it's great little strategy if there's some capital gains and somebody has crypto. Obviously, you have to have both of those issues for it to apply.
Yeah, I mean,
it's sexy as hell.
It's when I heard it, I was like, wait, is that right? And it was like perfect timing too, because crypto was up. I was happy as hell. I was up multiple six figures on it, and then it came back down, and it came back down hard to a loss. And I just sold it as soon as it hit 100K loss to capture that that loss
I'm
on.
telling you, that works so good. John uses that when he's talking to women, just to sound smart, right? How he's washing, he's doing his sales, offsetting
Washing my
losses.
crypto.
Uncle Sam's now my partner, Yeah. Who knew? It's so brilliant. It's a come on for women.
It's great.
Yeah,
Yeah.
it's a good strategy. What I'll tell you is just be careful, James. We talked about last time is you're going to sell it, buy it back right away. Don't play the game. I try to play the game. Let me wait a little bit. It's going to go down further.
Yeah.
Boom, it pops, and now it costs you. So yeah, interesting strategy. For those that don't understand, again, if you have a gain somewhere else, whether it be sale of a property, house, stock, any of those gains, you can offset it with a loss. And, essentially, crypto, you could just buy it back. Now you're restarting, what would you call the value?
Your basis.
Yeah,
so that's where crypto is a little interesting too, because I've heard that argument. Well, you're just restarting your basis. You're going to have to recognize those gains sooner or later anyhow. But that's not always the case. Like there may be a reason you decide you're going to exit out of your crypto position. But I mean, most of the major coins, Bitcoin, Ethereum, even a lot of smaller coins now, instead of having to sell if you need cash to exit that position and have to recognize that gain, now you can borrow against it. So instead of selling it and being forced to recognize a gain, you can borrow against that asset for cash needs instead of having to sell.
Yeah, it's such an exciting asset. It is a scary asset. It has made me sick a few times.
That's because you're trading the damn thing.
The emotions, no.
Yeah.
The swing in that daily swing in December that we took, that swing in December, it was a rough one. In one day, I was like, "Holy shit, my world's over." Anyhow,
ever seen a grown man cry?
Yeah, it's close. I was not happy. I was at dinner. James, we're healthcare advisors, right? And we train on this show is you've got these old school brokers, we call them brokers, that are managing benefits. They provide no insight on how to actually lower healthcare costs. So when we have talks, they talk about is portrayed to the prospect, it's like an accountant versus a tax strategist. Now, most guys on here don't know what that means. Explain to them the difference between a CPA, maybe a good CPA or tax strategist.
Yeah, it's a great question. I talked to a lot of people, and you and I met through marketing efforts that we did, and I talked to a lot of business owners, and they say, "Oh, I have a CPA, I'm good with that." And they do have a CPA, but the problem with the industry, and there's old school accountants and CPAs, tax preparers as well. Most tax people are tax preparers. They're taking the numbers you give them at the end of the year, and they're putting them in boxes and preparing hopefully very accurate, tax returns, and you're staying in compliance. So that's great. That's a great service. It needs to be done. We do that also. But the real value is taking, especially for a business owner, is taking a look at that whole picture, looking at that whole situation and saying, all right, I've been in the tax industry and I've been a CPA for 30 years. If I was in your shoes, if I was sitting in your chair, knowing what I know in your situation, what would I do? What would I do differently? How would I structure things differently? And that's the strategy, and the advising piece that obviously I enjoy a tremendous amount. And it's a lot of fun, but brings a lot of value. And I find that most CPAs are not set up to be able to do that side of things. They're great in compliance. They're very precise, but not necessarily on the strategy and the advising side of things. Some are great at it, but I think most aren't. And then the other problem with a lot of CPAs is if they are, or if they do like the advising and they have some strategies, you don't necessarily have a process for that. So when you work with your CPA or you're looking for a CPA, those are the kind of questions I would ask around is, do you like advising? Do you offer advising? Do you offer strategy? And what does your process look for that, for helping me with that? Do you have like a defined process for that?
God, that almost sounds like the business they're in.
I think it's similar.
Yeah.
Yeah.
It's very similar. We what do you call them, Craig? Historians, the CPAs.
I call them historians. Yeah, they file tax returns. For 40 years. Whatever the hell a magazine is, they do it. They do a thing. 50 accountants do a tax return. They all get 50 different answers every year for 40 years. So even though they might have a process, or even being a historian, it's confusing enough that they all come up with a little bit different answer.
Yeah, I thought I had a good accountant a while back when I first started. And I wasn't making shit. I wasn't making any money yet. Who knows? I was following probably a loss. But as I started to make money, I learned about a strategy of becoming an S corp, and then not paying the self-employment tax. And why in the hell did he not tell me this? Like, it's just mind-boggling to me. Talk to me about an S corp. Why maybe some of these guys out there, they're going as a sole prop or an LLC, why they need to switch to being an S corp, or why it makes sense.
Yeah, so at a high level and in very general terms, an S corp is a separate entity from yourself. A lot of, especially in the insurance industry, in the broker industry, most people start out as a sole proprietor, and a lot of people stay that way. The problem with that as a sole proprietor is that you have self-employment tax on all of your earnings. As a sole proprietor, you are the business, and the business is you. Even if you have an LLC, if you're a sole proprietor, you're paying self-employment tax on all of your income, or your net income.
That's what, like 15% ish?
It's 15% up to about 130,000, and then it's 3% forever, indefinitely.
Wow.
Yes, it's a big number. No matter where you are on that spectrum. So an S corp is a separate entity, but still what we call a pass-through entity. That's CPA jargon for you get all the profit. You have to pay taxes on the profit. But what you don't have to pay tax is you don't have to pay that self-employment tax on the profits of the S corp. And as a rule, IRS says you can't do that and not pay any payroll taxes. So you have to have some reasonable compensation or a reasonable salary if you own an S corp and you work in the S corp. But that's not too hard to navigate around. You set up a reasonable salary, you pay payroll taxes, have withholding from the salary, and then the rest of that profit. So let's say you have an $80,000 salary and you do 200,000 net. Well, the 200,000 net, you don't have to pay that 15% or that 3% tax on that profit that's coming from the S corp. So you can get really big savings by switching to an S corp. In the insurance industry, it's kind of a mixed bag, especially depending on what CPA you talk to, whether you should be an S corp or not be an S corp, because of the commission issue in most cases, where commissions are, unless you're a broker, typically they're being paid to you as an individual. So there's a couple extra steps we have to take, but an S corp still makes a ton of sense for your industry, for brokers and reps, to be able to shift that money over to the S corp, and be able to avoid those self-employment tax.
Yeah, I think the rule of thumb is somewhere around a third they want you to take, right? Third, let's say you're going to make 100 grand, they want you to take a $30,000 salary. And so, do the math. 15% on 100 grand is 15 grand. 15% on 30 grand is 4,500. So there's $10,500 in savings if you only
Yeah.
make 100 grand.
Yeah.
I mean, yeah, no
Significant.
brainer here. Free money. I know you had wrote down here, what can I start doing today to save 3,500? Was that going to be switching to an S corp?
Well, the S corp's a great one. It takes a little effort, to make all that happen. There's a few hurdles you need to jump through. There's another one, once you become an S corp, one of my favorite strategies is called the Augusta Strategy, and we use it a lot, and it's where once you have an S corp, you're supposed to have board meetings for the S corp. Even if you're the only employee, or if you're the only owner, you're the only board member, you're still required to have board meetings. So what we do is rent your house to the S corp. If you own your house, you can rent your house to the S corporation. The corporation can now pay you rent, instead of going to a hotel or go for some other place to have the board meeting. You can rent your house to the S corp. You reimburse yourself that rent or pay that rent over to yourself, as long as it's 14 days or less per year. There's no tax on that rental income. We still show it on the tax return, but there's no taxes that you have to pay on that as long as it's 14 days or less. There's that special incentive in the tax code, or rule in the tax code, that if your house is being rented for 14 days or less per year, it's not taxable. It's named the Augusta Rule because they figured out during the Masters, they could rent those course side homes for $10,000 or $20,000 a day. They're making a couple $100,000 during the course of the tournament by renting their homes for 14 days or less. So some pretty smart people figured that loophole out, but works well with the S corp too.
Yeah, free money, right, guys? Free money. A
I
lot of
got one for
strategy
you.
out there.
So let's say you get a more competent broker and they're happy with their W-2. You know, they work for a firm, their own or otherwise, and they, you know, they're fine with their W-2 income, but maybe they have some speaking fees. Maybe they have fee income that they'd like to take in separate from the corp. Would it make sense for them to set up another corporation to take that separate fee income if it's $50, $100, $250,000 and do that under a Schedule C separate from their W-2 because maybe they just don't have very many deductions?
I think that makes a lot of sense. You know, if it's 50,000, it makes sense to do it probably on a Schedule C. But now you can deduct, you know, expenses that you may not be getting reimbursed for from your employer, like home internet, cell phone, home office expenses, mileage. Unfortunately, on the Tax Cut and Jobs Act, the unreimbursable expenses, business expenses, went away. So you can't deduct expenses that you incur that your employer's not reimbursing you for anymore. But if you have some of the speaking fees and you have expenses related to that, it does make sense to put that on a Schedule C, deduct those expenses. If it's more than 50,000, like if you are talking about $250,000, I would again consider the S corp to avoid those self-employment taxes.
Yeah, that's a big number. Let's talk about. We were talking earlier about capital gains. You know, me and you had talked about some ideas and strategies and how we can offset. Now we'll get to real estate. Obviously, that's a sexy one, but what are some of the even investments I know that you're doing, recommending, and stuff like that? That hey, I can get a advanced deduction on an investment year one.
Yeah, there's some pretty cool things, especially for accredited investors, and that's most of the clients we're talking about here, and
Wait,
and obviously
did you just hear that thud? That we just lost half our audience.
That means what? Your net worth's $1 million and you make 200 grand a year at least.
or yeah, either one. Yeah, so if you're single, 200,000, married, 300,000, or net worth of $1 million or more.
Go for it.
Easy.
Yeah. So yeah, and obviously this is not tax advice or investment advice. This is informational, and you should talk to your tax advisor or financial advisor. But we do work with a lot of clients, especially clients that want to shift. Well, either create some tax deductions this year to offset other income, or start creating passive income that's tax advantage. Cash flow that may not be being taxed. Real estate, you mentioned, John, is a great one for that. Because you can get investments, either direct investments or syndicated deals where you get a lot of upfront depreciation. Some clients can take advantage of that. Some clients can't take advantage of that. But certain real estate structures allow for a lot of upfront depreciation. Another one is oil and gas, which is a super hot topic right now. But domestic oil and gas production, in the United States, there are tax incentives that allow for, we're seeing funds 80 to 90% depreciation in the first year.
Break that down. Give me in layman's terms. I put $100,000 into an oil and gas fund. How does that?
Yeah. So if you let's say you put $100,000 into an oil and gas fund, most funds will get you between $80,000 to $90,000 in depreciation that you can take in the first year against other income. So you'll essentially have a loss.
What income?
W-2 income, business income, any income.
Wow. It doesn't have
to be accredited. Yeah, that's the tough hurdle. But if you are accredited, then you can offset it against any income.
Yeah, I mean that's huge. I'm definitely. I know we talked about it 2 weeks ago. I'm definitely dumping some money in there because some of I'm sending over to you. Actually, I probably put it in the portal. Uploaded was a K1, so I put 150,000 into a real estate syndication. It had the advanced depreciation year one, and the K1 is like 170,000 deduction. Now that I assume can only be applied towards other real estate gains or capital gains? What can I utilize that for?
There's a lot with real estate. There's a lot of tricky rules. So, in a syndicated investment in real estate, if you're not a real estate professional, it's going to be considered passive. So that passive loss can be offset against any other passive income. If you are a real estate professional, and there's some tests, some hour tests and so forth to pass to be able to be a real estate professional. Don't
Marry
necessarily
a
have to have a
realtor, John.
license. Yeah,
Well, that's the
that's
future
a
for
big one.
me is when I sell the companies, I'm
Get your
going to
wife
be a real
licensed.
estate professional to get this deduction. Go ahead.
Yeah, we're working with a couple clients right now that have shifted primarily into real estate. They've replaced their cash flow, the salaries or the income they had from their business. They've replaced that with cash flow from the real estate, but they generate enough depreciation that they're not paying any tax on that income. So that's something to takes years to do and plan for and structure, but a great way to generate tax-free income for yourself.
So this 170 that I'm supposedly getting, that is only going to be able to be applied maybe in the future towards a
You don't
gain.
lose it. Yeah, it'll always be there. So if you
Right.
sell that investment, you've got that 170 to offset the income
Okay.
from the sale, or income. If it generates income as you hold it, it'll be able to
Okay.
offset that income, or other real estate holdings, income or profits.
Beautiful. Beautiful.
Yeah.
Yeah, I mean, real estate seems to be, they talk about that's 9 out of 10 millionaires are from real estate. That sounds a little high, but I'm sure 9 out of 10 millionaires
Not
own a
what
lot of real estate.
what's happened to real estate since '08. It's gone up for 14 years, because
Yeah.
money's so cheap. So yeah,
Talk to
that's
me
real.
about the strategy of so this is an interesting one, and again, this may apply to you guys doing stuff now, in the future. Things that I'm looking at is a 1031 exchange. Just what do they call it? Roll until you die or something like that. Is
Yeah.
borrow, roll it
Keep
over until you
kicking it down
die.
the road, right? Yeah, the 1031 exchange allows you to defer taxes on capital gains uh, and depreciation recapture. So when you have income from a sale, the 1031 allows you to defer pretty much all that income as long as you don't take any cash out, or pay down debt that you're not replacing in the new property. But you're essentially buying and selling properties through an escrow, so you're never taking receipt of that cash, and that allows you to defer the income from that property. And what's cool is in the past few years, there's been new structures that have opened up with the 1031 where you can 1031 from a house, sell the house, and buy an apartment complex. Um, and then
That's
a few
cool.
years down the road, sell the apartment complex and 1031 into a nicer apartment complex. And then you decide I don't want to manage properties anymore. It's too much headache. Now you can 1031 with a Delaware structured trust into syndicated deals, so that you're still, keep pushing it down the road, and not paying taxes on that, but you can have income from it, the whole way down the road.
It's beautiful, and it's like rolling. It's almost like an IRA where you can continue to buy and sell in your IRA without paying a gain on it. However, you can get cash flow is what you're saying out of
Yeah.
it. And so what these guys are doing is just rolling over asset, appreciating it, selling it, buying another one, right? So buy
Mhm.
it for 2 million, sell it for 4, right? Roll it, buy a private property for 4 million. Now cash flow on a $4 million property. It's
Exactly.
it's pretty sexy. Then if need be, you need money, you just borrow against the property,
Cash out
right?
refi. Yeah, that's a
Cash out
great way to get cash
refi.
out of it. And then the really sexy thing is, I do this for 30 years and I pass the properties on to my heirs. As of now, they get a step up in basis, so they don't pay taxes either. They inherit it
Wow,
at the
I didn't
market
know
value.
that.
So it kind of just
Wow,
disappears upon my death.
wow, that's how you build legacy wealth, ladies and gentlemen.
Yeah.
That is what the rich. That's what the Rockefellers do. Um, Yeah, I remember Kiyosaki talking about a guy who wrote the book Rich Dad Poor Dad talking about it's like, look, he's a real estate professional, I guess he's followed as. It's like, look, I make $1 million on book sales. I buy a property for 5 million. I put $1 million down. I buy $4 million. I get $5 million of depreciation on the building, and then it offsets my $1 million. I pay no taxes. Right? It's like, wow. It's pretty sexy. So you guys, there's a lot of strategies out there. You just got to work with the right professional, like yourself. You're talking about all the healthcare strategies. Same applies here, man. There's a lot of people that know what they're doing, and a lot that don't. Somebody asked a question here: can I buy portions of my own agency with a Roth IRA?
There are ways to use retirement funds to buy or invest in your business. It's super tricky. There's a lot of rules. Some of them, I think the most popular plans are called Rob's plans. It typically requires that your agency is going to be a C corp, so there's additional rules to follow. It can be done. I usually recommend not going that route if you can at all. Not go that route just because of the additional rules and complications it adds to running the business and making sure that money um, is taken care of well. Because if your retirement plan owns half of your business, then half of the profits are going back to that retirement account. And that may be good. In some cases, you want to structure it that way, but not necessarily in every case.
Two-part question. You're, high tax state like California and New York, and you're going to form this separate S corp from your regular business. Does it behoove you to use some other state more friendly, Delaware, Nevada, Wyoming, for income tax purposes, or is that more asset protection?
That's a good question. We get that question a lot, really. Should I be a Delaware LLC or S corp instead of a California or New York LLC or S corp? The problem comes back to where is the business? If I live in California and I'm running the business out of California, well, all that income is the fancy word that CPAs use is called apportionment. We're going to apportion all that income back to California. If there's no income being generated in Delaware, then we can't apportion any of that income to Delaware. It's all going to go to California. You're going to, at the end of the day, you're still going to be taxed the same way in California as you were before. Now, if you have employees in Texas or Nevada or Florida, you're going to probably apportion some income to those states, which is helpful. But typically, as a California resident, you're still going to pay taxes on the total income. The reasons for Wyoming or Delaware or Nevada LLC or corporation tend to come back to legal issues, not as much tax issues because of that apportionment. You're still going to pay the tax based on where the business is based. But Wyoming has, and I'm not an attorney, so don't take my legal advice. But Wyoming has some great anonymity laws and the ability to set up LLCs and be anonymous in terms of what you own. Delaware has great investor laws, which is why most of the tech firms are set up as Delaware corporations. So it tends to, those states draw people really more on the legal protection side than the tax side.
Yep.
Well, unless you move to Nevada like me. Yeah, that's it. That's why I'm here. People go, "What made you move to Nevada?" I'm like, "Taxes. What else?" Yeah.
California clients say, what can you do for me in California? Like, when can you move out of California? That would be the best
Exactly.
strategy.
That's my best advice. Leave.
Yeah. California, Craig's over there still. He loves that weather, but you pay for it. We got another question from Ray. What if you don't have employees in other states, but you have clients in other states? Does that change?
That's okay. Yeah, there's a concept in tax law called nexus, and nexus means you have a presence in the state. So if you don't have an employee, if you don't have an office, if you're not running regular routes or our sales calls in the state, then you typically don't have nexus in that state, which means you don't have to apportion income to that state.
Got it. Somebody says, yeah, and guys, funnel in some questions if you want. I own my building with no mortgage. Can I charge myself rent?
I assume you're talking about the business, charging, if you own the building, charging rent to the business. I typically would. You want to, again, we were talking earlier about
hopefully you own the
losses.
building in a corporation of some sort.
Yeah, at least in an LLC.
Yeah.
Yeah, so typically we do set that up where there's rent being paid. Because if not, you just have expenses, sitting over on your tax return that are generating losses that you probably can't take advantage of. So we want to pay some rent. and get the deduction in the business to offset the real estate taxes, the liability insurance, the depreciation, and at least break even on the real estate, and then create the lower income in the business.
So here's another question. So let's say you got 2, 3, 4 buildings. You own each one in a different LLC. Maybe you set up another corporation that does the property management and charges everybody 7%, and then you shelter all of that income in the property management LLC with a pension plan for yourself.
Absolutely.
Can you do that?
Yeah, as long as it comes back to those passive losses. We don't want to create income over here at the expense of losses that we can't take advantage of. So that's what we're always trying to balance. But
Yeah.
if you're break even on the real estate and you've got income that you can throw into a cash balance plan or a SEP or something like that, that's a great strategy.
Yeah, you can get, I think, a solo 401k that you can deduct up to 50-something thousand dollars. Now, I got sold by an attorney firm that, said I could do it, but I didn't have any rental income coming in. Well, I did, but I sold the building, and then they said, well, you could just pay yourself a consulting fee. And it was like, that was pushing the envelope. But you want to get money into, basically income into that management company to take advantage of a solo 401k, I guess was the plan. But I don't know how correct they were. But a lot of different ideas. That's one show we should do on LLC corporate structure for sure. What else should we know, James, that I'm not covering?
Yeah, easy deductions that people are missing that are out there.
Yeah, easy deductions. Some of them are small, but they add up really quickly, like cell phone. A lot of people pay their cell phone through the business, but sometimes we see that's not being caught. Home internet expense. The IRS said that you can take 100%. If you have a home office, you can take 100% of your home internet. Keeping track of mileage. It's a tough one, and nobody likes keeping a mileage log. I hate keeping a mileage log, but keeping track of that's really important. You don't want to have to go back and recreate that. And if you're not expensing the vehicle through the business, then mileage can be a super big expense, especially if you're going around directly to clients. We see a lot of times insurance benefits missing from tax returns where like an HSA, the contributions aren't being deducted, or the self-employed health insurance for the business owners, it's getting lost somewhere, or it's being paid for individually and not being deducted. So all those things can add up, to be $20,000-$30,000 in expenses altogether.
Yeah, they add up. Guys, if you have any other questions, put them in, and we're going to wrap it up with James. James, I know we did a consultation. So basically, talk to me about your process. If you have people listening, this is going to go out a lot. This is live, obviously. It's going to go out to 1,000 people on the podcast. If they're, in a situation where, hey, they have a historian and they want to talk about tax strategy, talk a little bit about your process, how they could reach out to you, and kind of what you guys do from the strategy and the filing standpoint.
Sure. Yeah. So obviously we're deep in processing, compliance and preparing tax returns right now. It's just kind of the nature of the business and what we do. We're preparing a lot of returns. If you need that done, we'd be happy to help you with that. If you want to talk strategy, I'd love to talk strategy with you as well. Reach out to me. My email is james@rainwatercpa.com. Feel free to reach out to me. Our process is, normally I'll meet with you, or we have another person that can meet with you, and just go over your situation. There's no charge for that call. We go through your whole situation, see if there's opportunities there, if there's things on the strategy side that you could be using and putting in place, and then to see if it makes sense to work together. Regardless, our goal is to get you value in that initial call so that you have a path to go down, whether you work with us or decide to work with your existing CPA or somebody else, that there's value in that first call that you can take and make some action steps out of that.
Yeah, so AKA call James and then file an extension on your return, because you're gonna want to give yourself some time to get all the stuff. It's a lot of work. It takes stuff. I mean, we do a call quarterly. You guys send me an email. With a calendar link, I book my quarterly call. It might be a 2-minute call. It might be an hour call. It just depends on how much I got going on. So get yourself planning right? Just like you tell your clients to plan for the long term. I think, is there any long-term things that we missed for planning long term, or that people should think about the long game, like we always talk about on here?
Yeah, the long game is it kind of comes back to that structure of, where do you want to be in 10 years, 20 years? Probably
Because
like
these
you said,
guys,
too, with your
a
clients.
lot of them, James, are going to sell their agency at some point, right?
Right.
And so
So
that
what's next? Yeah. Yeah, oftentimes, an exit is a great opportunity to look at real estate or oil and gas or, some of these other investments that are going to start creating that I say passive, there's no real passive investment where you don't put any effort into, but near passive, investments that start generating tax advantaged cash flow for you.
Here's an
Yeah.
easy low hanging fruit, right? There's still a schedule of taxable layers, right? And so pay attention to what those layers are so you don't trigger the next tax layer, right?
Yeah.
And so figure out how to shelter, get deductions so that you stay within this range and you don't go to the next range, because it might be going from 30 to 37 or whatever the percentages are. So that's why you need somebody who does tax planning, because just doing mid-year tax avoidance strategies like that can keep you out of the next highest tier.
Yeah, John mentioned the quarterly meetings that we do, and each quarterly meeting we try to dial in like, hey, what are your taxes going to be for this year? What do all the numbers look like? What do the projections for the taxes look like? And where do we need to shift maybe, to do exactly that? Stay in the brackets, manage and control the income instead of just being kind of victim to it in January or February of next year.
Especially if you're making quarterly estimates.
Yeah.
Yeah, guys,
Yeah, that can
you're
sneak
supposed to
up
pay
on you.
quarterly. Yeah. Yeah, I mean, I think it's great. I'm glad that I was able to meet you and get my shit together, because we as insurance agents, we just don't ever, we put all of our stuff to last, right? We're just closing deals, most of us. And so we don't have somebody in house handling it. So get yourself a bookkeeper, a good tax strategist, and some protection on those LLCs, and protect the money that you're making, because the number one expense becomes taxes. Once you start making real money, it's taxes, and unfortunately, for people that are W-2, like my brother in Japan, he calls me crying all the time about he's 50+% in taxes, and he doesn't make as much as me, and I'm paying a ton less in taxes because I own a company. I can take advantage of these different things and investments and stuff like that. And so you guys are in a great position as a business owner, because we get the tax breaks because we create the jobs. We take all the risk. So the IRS gives us the benefits. But obviously, you got to have a partner that is an expert in helping you access those ideas and strategies. So once again, James, thanks so much for joining us. Thanks for the insight and free information. Guys, take advantage of it. Check out James at rainwatercpa.com. You can book a simple call with him. He'll have a quick chat with you. Email him, James at rainwatercpa.com. If you're listening on the podcast, go ahead and check out our website. We'll have all his information there, and you'll probably get an email with a direct link to his calendar to book a time so you can find out more. That being said, James, we'll have you on again, maybe in the near future for sure. Keep bringing us the ideas, all right?
Thanks, guys. Yeah, thanks for having me. It's a lot of fun.
All right, guys, take care. Thanks for joining us. See you next week, same place, same time, 8 p.m. Eastern, 5 p.m. Pacific. Heads Up Advisor. Be good, guys.